Well, welcome everybody. I think we'll get started. This is a webinar on cross-border estate planning. As an Aussie myself living in the UK, it's a concept that not necessarily had to deal with a great deal, particularly inheritance tax, which is a UK concept. So today we'll be just discussing various issues related to estate planning, but also, I guess, if you've had some relationship with the UK and have an involvement where it exposes you to inheritance tax in Britain particularly, we'll be discussing a lot of those principles, regardless of whether you're here or in Australia or making a move in one direction or another. Whilst Australia doesn't have inheritance tax per se, they have a cute little capital gains event that can also affect stuff when you're bequeathing some of your estate to others that live overseas. So our presenters will be covering that off today, so hopefully you'll enjoy it. Just in terms of the agenda, just a little bit of housekeeping. That's mainly that you'll be on mute, so you can't speak. But if you'd like to make a comment, particularly like one about how the webinar is actually working, put that in the chat function. But towards the end, as you'll see, we'll open the floor to questions. If you see it on somewhere on a screen ribbon that you have, there's a Q&A button. We'd really like you, as you go along, if you've got questions, pose them in the Q&A button. And then the presenters, James and Alan, will answer those in that special session. So they will just travel through their presentation. We will be talking, Alan Collette, I'll introduce them in a moment. We'll be talking about inheritance tax and capital gains tax in Australia. And then we have a special guest, James Wiley, who'll be talking about estate planning. That'll all be summarised. We can talk a little bit about how BDH, Sterling BDH tax and Hall & Wilcox can help you. And then we'll get into the question and answer section. My name's Stephen Ford. I'm the head of UK advice. I'm going to be the MC and the chief button pusher today. But I'd like to introduce Alan Collette, who is the managing director of BDH Tax. He's a chartered accountant in both UK and Australia. And so can speak on those and does a lot of work on cross-border taxation related issues. And our special guest today is James Wiley from Hall & Wilcox. He's a partner there and he specialises in succession planning, particularly for those with considerable assets. So again, folks, just a reminder, if you want to ask a question, pop it in there. If you've got just an issue around the audio or any other things related to the execution of the webinar, pop that in the chat for me and we'll try to address them as we go along. Without further ado, I'm going to kick off and hand over to Alan.
That's super. Thank you, Stephen. Good morning, good afternoon, wherever you may be. I thought we'd start with a quick run through of the basics, the inheritance tax basics. So most commonly, inheritance tax arises on the death of an individual who's living in the UK or who lives outside the UK and has UK-based estate. Assuming the deceased person's written a will, the issue will arise when the executors of the estate are going through the process of seeking probate to allow them to administer the assets of the deceased in accordance with his or her wishes. Special inheritance tax returns are required to be submitted, prepared, lodged with the revenue, and the inheritance tax position is required to be computed with reference to the chargeable value, the chargeable estate of the deceased. When the deceased is married or has a registered civil partner, a bequest to the surviving spouse or the civil partner is not subject to inheritance tax, so long as the spouse or civil partner is domiciled in the UK. Where the spouse or civil partner is not domiciled in the UK, the amount of the bequest that is exempt from inheritance tax is often limited to the amount of the nil rate band. We'll talk about domicile in a minute. The inheritance tax nil rate band is the amount of a deceased person's estate that is exempt from the charge to inheritance tax after deducting exempt amounts. It's presently £325,000. The amount hasn't changed for many years, and there's no present indication of an increase. The net estate that is valued at more than the nil rate band is taxed at 40%. So the tax payable can be significant. The nil rate band is available for the taxation of the estate of the deceased person and doesn't change if there are one or more beneficiaries of the estate, nor if the beneficiaries are residing in the UK or elsewhere in the world. It's the same nil rate band. In the last few years, the UK has also introduced a main residence nil rate band, which now amounts to £175,000. This is in addition to the basic nil rate band. And this is available when a former main residence is bequeathed to a direct descendant. Where the net estate of the deceased exceeds £2 million, then the £175,000 main residence nil rate band will start to be tapered away. As already mentioned, when the deceased person is married or has a registered civil partner, a bequest to the surviving spouse or civil partner is not usually subject to inheritance tax. A typical basic will provides that upon the first death, all of the deceased's estate passes to the surviving spouse or civil partner, and on the death of the second person, the estate passes to children or to other family members. This means that the nil rate band and the main residence nil rate band are not used on the first death. In this situation, if this situation arises, then any unused nil rate band and main residence nil rate band are available when the IHT position is being determined for the estate of the second deceased. So what steps can we take to mitigate the impact of inheritance tax? I'll talk in a few minutes about moving to Australia and changing your domicile as one option, but more commonly encountered strategies will include making lifetime gifts, known as a potentially exempt transfer or PET. An outright gift is not considered to be part of the deceased person's estate, so long as the person making the gift survives for 7 years. If the person making the gift survives for more than 3 years, but less than 7, a proportion of the sum gifted is added back into the deceased's estate for inheritance tax purposes, with the proportion reducing the longer the person making the gift survives beyond those 3 years. You should also be aware that gifting certain assets or investments can give rise to a capital gains tax position based upon the value of the gift at the time it was gifted. For example, shares and property, assets that would give rise to a capital gains tax position if they were sold by the person who is making the gift. Of course, if an investment is showing a capital loss, it can be gifted without a tax liability arising, and so might form part of a strategy of reducing your capital gains tax bill in the UK if you want to realise assets that are showing a capital gain. Gifts of a small value are IHT effective immediately. In other words, there's no need to live for longer than 7 years for the gift to be disregarded. So you can give away up to £3,000 in any one tax year without attracting inheritance tax. If you've not used this allowance in the previous tax year, you can bring an allowance forward for 1 year. The allowance is based on the individual who's making the gift. In other words, you can't make an IHT exempt gift of £3,000 to one person and another IHT gift of £3,000 to another person. It's £3,000 per donor. You can also gift up to £250 as many times as you like to as many people as you wish. You can regularly gift any excess of your after-tax income without paying inheritance tax. This is known as gifts out of income. For example, if your annual after-tax income is £80,000 and you can demonstrate that you only need £50,000 to maintain your lifestyle, you can gift up to £30,000 each year. If you're planning to adopt this strategy, it's important to keep a record of your after-tax income, your living costs, and gifts that you make, and to ensure that the executors of your estate know where this analysis is available so they can use it when the need arises. Certain investments are also eligible for other IHT reliefs, including business property relief. Domicile. The concept of your domicile is key to the scope of inheritance tax. The estate of a person who was domiciled in the UK at the time of their passing is subject to IHT on their worldwide estate. By contrast, the estate of someone who is not domiciled in the UK is only subject to inheritance tax on the estate that is located in the UK. Estate of the deceased person who's domiciled outside the UK, where the estate is located outside the UK, is outside the charge to UK inheritance tax. An IHT strategy adopted by many, therefore, who are moving to Australia is to take steps to sever their UK domicile and to move assets and investments outside the UK, for example, to Australia. So domicile, we're all born with a domicile of origin. This is usually where our father was born. If you do not have a UK domicile of origin, you can become what is called deemed domiciled in the UK if you live in the UK for a long period. The threshold is 15 years of tax residency in the UK in the last 20 years. If we find ourselves with a UK domicile, either of origin or deemed, we can acquire a domicile of choice when we relocate to live in a new country, for example, in Australia. To reasonably assert a domicile of choice in Australia, it must become your permanent home. Visa status or being an Australian citizen can be important here, as you should be able to demonstrate you can lawfully reside in Australia for the long term. So a 4-year employer-sponsored work visa in Australia is not going to be adequate as a means of reasonably claiming to have acquired a domicile of choice in Australia. A signed statement of your long-term residency intentions is also desirable. I know that James can assist with these statements of domicile, and these should be retained with your will, so your executors have documentation available to support an assertion of the deceased's non-UK domicile status and to rebut any future challenge from HM Revenue. Remember also to consider the capital gains tax position if you cease to be tax resident in the UK, particularly if you retain residential property in the UK, which might be sold while you're still alive. Those who are non-residents have been subject to UK capital gains tax on the disposal of residential property since April 2015. So be careful if you have a UK domicile of origin, decide to move to Australia and cease to be tax resident in the UK. In 2017, the UK made significant changes to inheritance tax affecting individuals with a UK domicile of origin who were born in the UK and who have acquired a domicile of choice elsewhere. Such people will have a UK domicile revived if they become tax resident in the UK again. If you are in this situation and are planning to spend more than a couple of weeks in the UK during a tax year, it will therefore be very important to have an understanding of the provisions of the UK statutory residency test if you want to limit the scope of your estate's exposure to inheritance tax. Turning to the position in Australia. As you may know, Australia does not have death duties. This means that as a rule, assets can pass from one generation to the next without a tax charge. However, where the estate of a deceased person includes a CGT asset, such as an investment property in the UK or shares in a portfolio, and that investment passes to a beneficiary who is not tax resident in Australia, a capital gains tax liability can arise, which is payable by the estate. This situation can particularly affect people who move to Australia and whose children subsequently return to the UK to live or to study for a few years. Steps can be taken to mitigate the imposition of this capital gains tax, most commonly by including provision for an Australian resident trust to be set up in your will. Again, this is an issue with which I'm sure James can assist. So this concludes my part of the presentation. I hope it's helped to improve your understanding of some of the issues. As Stephen said, please feel able to send questions to us about the issues I've just discussed through the Q&A function or directly to us by email after the seminar. Thanks, Stephen.
All right. James, over to you.
Thank you very much, Stephen. So hello, everyone. I'm going to be talking around estate planning and some common issues which we see generally, and the importance in general of having a will and some other documents as part of your estate planning, and then focusing on particular issues where we have individuals with assets in both the UK and Australia. One is whether or not to have a separate will for both countries, or one will which covers everything, and also go a bit further in terms of inheritance tax, covering, Alan's already very helpfully covered it, but some of the other things we look at in terms of planning, more so from an estate planning perspective. Just moving on to the next slide, please, Stephen. I think just move through, and the next one after that. Thank you. Usual disclaimer, being a lawyer. So I'm not sure why this slide hasn't come up properly, but I might move to the next slide. Sorry about this. I was coming, yeah. So, what I'm going to be covering today is just some common estate planning triggers for you. So importantly, wills, which everyone thinks about when they have conversations about their estate planning. But importantly, assets don't actually form part of your estate. So in Australia, we have superannuation, which is a form of trust, and in the UK, we have pensions. It's important to look at appropriate strategies around that as to whether or not that would form part of your estate, or how you pass that to beneficiaries. Also covering incapacity documents. So this is what happens when you're still alive, but you have an accident or illness and can't make decisions for yourself. In the UK, it's called a lasting power of attorney, and that can cover financial and legal decisions, and also health and medical decisions. In Australia, commonly it's state-based, but it's commonly called an enduring power of attorney for financial and legal decisions. And then depending on which state you're dealing with, in New South Wales, for example, it's called an appointment of enduring guardian for medical and lifestyle decisions. Importantly, even if you choose to have a will which covers your worldwide assets, you still need to have local incapacity documents, because, for example, an Australian enduring power of attorney will not be recognised to deal with your UK assets. Moving to the next slide here. So why should you do it? So one thing we often come across is clients who don't necessarily have a will at all. And if you don't have a will, you die of what's called intestate. And this is a concept both in Australia and the UK. And then the legislation will decide what happens to your estate. In a traditional family scenario where you've got a couple who are married, no second relationship, perhaps children, this might result in the intended or the intent of what you want, assets passing to the survivor if you're both not around, to children. But particularly, these days we're living in the age of second or third relationships and factor relationships, and that doesn't necessarily result in the intended outcome that someone would want. And even where it does, we often find that having an intestate estate takes longer to administer from an administrative perspective, and that involves more costs and uncertainty. What about having an old will? So we often come across situations where clients might have prepared wills many years ago, and there's been changes to family there. So for example, they've got married, and not a lot of people know that when you get married, that revokes any previous will which you've made, but it might be the fact that you've had children, and perhaps not all the children are named in your will. These days, Alan touched upon this concept of what's called a testamentary trust, but often we'll recommend that they be included at least as an option for a number of reasons. So a testamentary trust is just simply a trust that is set up in your will. It's not set up now, so there's no ongoing costs or compliance. Just simply there's a trustee that effectively sits at the back of your will. And there's a number of benefits of this. So one is asset protection. In a scenario, say, for example, where one of you is in an at-risk position, say you're a doctor or a lawyer, have their own business. Also, that might be your children. So it's looking at how assets are passed to children and giving them the benefit of testament trust. All a trust is a separate entity, but it effectively provides a barrier, for example, to creditors. And depending on how it's structured, it can also provide protection against relationship breakdowns. That can be, for example, the surviving spouse going into a new relationship and you wanting to provide for certainty of your assets passing to your children, not to that future spouse or perhaps their own children. But it might also be concern around your own children and concerns of their respective spouses. In Australia in particular, there are taxation benefits for testamentary trust as opposed to receiving assets outright. And Stephen, if you could just move on to the next slide, which is designed to highlight them. So a unique benefit of a testamentary trust, unfortunately, you can only get this benefit with someone dying, are tax benefits in respect of distribution of income and gains, and particularly for minor beneficiaries, so children under the age of 18. So this might be for older clients, grandchildren, or for younger clients, their own children. And what a testamentary trust allows is distribution to be made to each minor child, and each of those gets $20,000 approximately tax-free every year, and then the marginal rates of tax. So that can be used for saving quite significant amounts of tax there, which that slide there is designed to highlight the two differences of no testamentary trust versus testamentary trusts for children. And sometimes this is why we at least recommend having them as an option there, because the beneficiary can also potentially decide if they want one, depending on their circumstances at that time. Moving on to the next slide, please, Stephen. So this is just highlighting some common triggers to either prepare or update your estate planning. So having children is a very common one, given the concern around wanting to protect children there in the event that your assets are looked after for them. But what would happen, for example, if you were to die and your children were to be under 18? So who acts as guardian there? But it might also be your own children having children, providing for them and trying to maintain the family wealth within the bloodline there. Relationship changes, I mentioned with marriage, but often unfortunately it might be relationship breakdowns as well. And unlike marriage, when you separate from someone, it has no effect in relation to your will or your incapacity documents. But more often than not, when we are faced with a situation like that, it's often the case that someone doesn't want all their assets passing to their other spouse who they're at war with. And it's only when you actually formally get divorced that that spouse is treated as dying before you. Illness is a common trigger as well, that whether that be the illness of your partner or perhaps one of your children, and looking at how your estate is structured to protect them. So commonly what we call a trust there to make sure they're looked after, but in the event, for example, they can't manage that money themselves. And retirement and superannuation changes, which I'll come on to in a moment, making sure that that's dealt with in accordance with your intentions. Receiving an inheritance is also a common trigger. This might be younger individuals who have older parents and thinking about how do they receive that inheritance. So as opposed to receiving it outright, potentially suggesting that they at least have the option of a testament trust, for example, for the benefits discussed earlier. And assets overseas, which we're focusing on today just with the UK and Australia, but it also obviously applies to people with assets in other countries. Thinking about investment changes, which is a lifetime decision, but looking at how succession to those assets is dealt with. So for example, sometimes we come across people who set up a family trust, which is very common in Australia. It's important to think about what happens to succession to that trust if you're not here. And finally, buying and selling real estate is a very common one, but it's important to think about how you own that real estate, whether, for example, if we've got a couple, if one of you is in an at-risk position, that we think about who should own that property, but then also the impact upon your wills. So thinking about protective mechanisms there to maintain that protection as well, together with any tax planning benefits, for example, for investment properties. Moving on to the next slide, please, Stephen. So with superannuation, this is talking about Australian super, we're somewhat restricted in terms of who we can leave that to according to superannuation law. So set out on this slide are the beneficiaries you can leave super to, which is a spouse, including de facto, children, and a person who you're in an independent relationship, or your estate there. And it's important, therefore, to have what's called a death benefit nomination in place to direct the trustee where to pay your funds to. And because if you don't, then the super trustee will decide where that's paid to. And more often than not, we're often dealing with a third party, because likes of some super in Australia, for example, who may not pay that as you wish. So we always suggest having a death benefit in place, but thinking about the tax implications as well, particularly with people from the UK. And if it is the case that you're still UK domiciled, then an issue can be whether we would want, for example, that super to form part of your estate. So that's another thing to consider. Moving on to the next slide, please, Stephen. So I'll just flick through these slides quickly because I've already covered them, but this is important in terms of thinking about incapacity documents and the types of decisions that covers off. So operating bank accounts, managing investments, paying bills, and selling property. Importantly, we suggest having a tiered nomination for both enduring power of attorney and also the guardian role or lasting power of attorney in the UK. So often people will find might have done it, passing it to each other if we've got a couple, but not necessarily thinking about if both of them are incapacitated, what happens then? So thinking about someone else, and it can be multiple people to make those decisions. But also with the guardian role or the person who's making medical decisions, potentially including directions around life support there, because it often is a very difficult decision to make, if you have to turn off someone's life support, and it's possible to include directions around, for example, relying on the opinion of 2 independent doctors if that's what you want. Moving on to the next slide, please, Stephen. So now we're going to talk about UK assets and issues where you own assets in both countries. So Alan was talking about the concept of domicile before relating to inheritance tax. It's also important in relation to dealing with your assets, or rather what law applies to particular assets when you die. So domicile comes in here because when you die domiciled in a particular country. In Australia, it's actually state-based. So if I were to die domiciled in New South Wales, what that means is that New South Wales law will apply to my worldwide, what we call movable property, which is essentially everything other than real estate. So all shares and cash, for example, that I might have in the UK is actually governed by New South Wales succession law. The only thing that's not is what's called a movable property, which is essentially just real estate. So if I were to have, say, a property in the UK and a property in New South Wales law would apply to the property here, but UK law would apply to the property in the UK. Fortunately, because we're dealing with 2 Commonwealth countries, it's possible to have one will which covers both. And that's probably the simplest thing to do, because then you only need to worry about having one will, potentially updating that down the track, and obviously the cost of just having one will. But often we'll recommend as best practice to actually have separate wills in both countries, particularly where you've got people with significant assets in both, or even where they've got assets in both countries where they may rely on having access to both, so the income from investments there. Reason being is if you only have one will and I were to die, for example, domiciled in Australia, you need to get what's called a grant of probate in Australia or in New South Wales, and that typically takes at least around 3 months, often longer to get. And then once I've got that, I need to get that what's called resealed in the UK. So you're effectively taking that process, making it last twice as long. And assets in that process, unless it's just a joint account, are effectively frozen, so you don't have access to that. Whereas if I had a separate will in both countries, I can make sure that you can get the grant of probate at the same time. And importantly, you can make sure that they're structured to achieve the best tax outcome in both countries. Looking at tax issues in terms of inheritance tax planning here, which Alan helpfully provided planning ideas for and then a summary of how it works. One thing I would just flag there, though, is in the past we often found that clients may have taken the approach, why do I need to worry about inheritance tax? How are they going to find out about my assets in Australia or elsewhere? And whilst I perhaps wouldn't have advocated that approach in the past, unfortunately we now live in the world of information sharing, where tax authorities in both countries and financial institutions are sharing information. That approach of putting your head in the sand and hoping they won't find out is not the best approach there. The other thing Alan touched upon was capital gains tax, what I call Australia's backdoor inheritance tax, where you've got beneficiaries living, say, in the UK, and you've got assets passing to them. Alan summarised how that works, but one of the things is to think about if we are, you've got one of your children, say, living in the UK and another one in Australia, and how do we deal with that? Because who pays the tax there? Is it the estate that pays the tax, or is it that particular child who's living overseas who pays the tax there? and then it can potentially result in inadvertent inequality there. But there's ways to deal with that through the will, for example, an equalisation clause if that's what you want. But also importantly, if it's a possibility that child may come back to Australia, giving them at least the option of a testamentary trust that is an Australian tax resident trust, because that means that the assets aren't passing to an overseas beneficiary, and then they might ultimately come back to Australia, and it prevents that capital gains tax applying. It's even more punitive where it does apply, because Australia doesn't have an inheritance tax. So there's no double tax treaty relief there. So you can potentially end up paying both inheritance tax and capital gains tax, which obviously is the worst outcome there. And one final thing just to cover there is also thinking about executor tax residence, which is an issue both in Australia and the UK. And what that means is there's different rates of tax applying depending on whether your estate is, for example, Australian resident or non-resident. And often it's more beneficial to have an estate in each country being tax resident for that particular country. But then you need to think about, what we call the tax residence of your individual executors. And it might be the case of at least having, one Australian tax resident executor, even if the others are not, to make sure your estate here stays tax resident. And similar concepts apply to the UK. Just going through a few other points with inheritance tax planning here, which Alan helpfully covered off here, but I'll just touch upon a few other issues. So one thing also to think about is where you're leaving assets to a surviving spouse, and to try and get the spousal exemption where you're both in the same domicile position. You have the option of either leaving assets outright, or in what's called effectively a lifetime interest trust, where sometimes that is used to protect against second relationships there. But importantly, if, for example, it just passed to what we call a discretionary testamentary trust, which is quite a common thing to use from an Australian perspective, and that wouldn't qualify for the spousal exemption there without special terms. And that's something we sometimes see, for clients who are living here, where their wills haven't been drafted for UK inheritance tax planning there. And Alan mentioned the concept of what's called the statutory declaration of domicile as well. So that's something we often will advise clients who've been here for a while and have clearly acquired a domicile of choice in Australia. The purpose behind that is to provide a formal legal document, particularly if that both clients are not here, if we're dealing with a couple or just one client if it's an individual, and that is used as evidence should HMRC dispute your domicile status, because it formally sets out your background and the reasons why you moved to Australia and why that was, and in particular focusing on why you prefer, say, living in Australia, whether it's the lifestyle, climate, career opportunities, bringing up children, for example, and setting out kind of as much focus as possible on Australia, the better. And that is used evidence should HMRC assert that you haven't acquired that domicile of choice. To be clear, it's not legally binding on them, but our approach is it's much better to have that in a formal document than be trying to make that argument after death when you might not have that evidence there to provide that. And the final slide, just finishing up here, which again Alan explained, was just thinking about some of the changes we saw in 2017. If you are impacted by these, so quite a common thing in the past was to hold, for example, residential property by, say, an Australian trust because it kept outside the UK tax net. That strategy no longer works. So you need to look at, does it make sense still to have that? But also, people moving back to the UK who become inadvertently tax resident who are originally from the UK, there's significant changes there as well. So just be aware of that. As Alan was mentioning, it can be quite easy to become tax resident, but it's important, you get advice before that, which Alan is very well qualified to advise on. So that brings me really to the end of my presentation. There's a few slides here as well, just explaining about Hall and Wilcox and how we can help as well should you have any questions or need assistance with your estate planning
James, are you able to, Horn Wilcox, able to help with UK wills, etc.?
Yeah, we don't have a UK office yet, but there's a law firm or firms that we work with regularly, where depending on what a client wants to do, we'll often instruct that firm on their behalf. So they only have to deal with us, and they will prepare the UK will if we're going down that route, and also a lasting power of attorney. Or if someone has their own firm that they deal with, we're happy to work with them as well.
Okay, no, that's good to know. Thank you. Okay, folks, so that ends the formal presentation. So I guess we're over to questions. Alan, I don't know whether you've had a chance to start looking at the questions, or do you want me to start reading them out?
Maybe you could read them out as we go, Stephen, if that's, and then between James and I will comment appropriately.
Okay, so the first question is, what happens if a parent in Australia makes significant gifts? I assume they mean to the people in the UK, and B, when they pass and I inherit as a UK resident. So I guess that relates possibly to the being in Australia but bequeathing assets to a UK resident. What about if an Australian makes gifts to a UK resident? So
I think it depends upon the nature of what's being gifted. This might trigger a capital gains tax position if what's being gifted is ownership of what's called a CGT asset. So if there are shareholdings that are gifted to a child in the UK, I think there might be a capital gains tax position there that references the market value at the time of the gift. I think there's potentially a capital gains tax issue for the donor. If it's cash, I perceive that would be okay. No capital tax issues there, I believe. Would you concur with that, James, do you think?
Yeah, I would do. And I think the other point was, when they pass and I inherit as a UK resident, that would just, the point there is just it really increases the size of your UK estate, both, in terms of general income and capital gains tax, but also then, when you die, you've got more of a UK estate subject to inheritance tax there. So it might be possible, for example, to keep that out of the UK tax net, depending on how their will was structured there in Australia, because it may be structured by a trust, an Australian trust there.
Yeah.
Patricia, feel free to rephrase the question if I didn't quite read it out as you'd intended. Another question related, and I think we've possibly answered this, but I'll throw to you for this one, James. I have a current will prepared by an Australian lawyer. Is this eligible in the UK? Yeah, it is, because the UK will recognise an Australian will given their Commonwealth jurisdiction. So there's not an issue there. You mentioned in the presentation that you recommend 2 separate wills, though. What's the main reason for that? It's mainly for administration, because you're not having to then, if you just have, using that example before, an Australian will, UK assets, it would be seen as a worldwide will. And then if you died in Australia, you would need to get the grant of probate in whatever state you live in, and then get that resealed in the UK to do with your UK assets. That process, you're effectively potentially taking twice as long. And if it's only, not that much in the UK, then that kind of strategy we would probably advise. But, if you've got sizable assets in both countries, and you need access to those in particular, it makes sense to have a will in both countries. You need to be careful, though, in terms of how that's drafted, because both wills need to have a specific clause in that would say, for example, this is my Australian will and covers my worldwide estate other than that situation in the UK. And then the UK will just had a clause in which said, this will only applies to my assets in the UK. Because the normal will have a clause in that revokes all previous wills. You might end up accidentally revoking another will, or at least conflicting with it. Okay, that makes sense. Okay, I've moved all my assets out of the UK except a share in a piece of land which I'm currently negotiating a sale to a family member for £30,000. I had it valued immediately prior to moving over here, which here must be Australia. I am therefore subject to CGT on the gain in value made since I moved here 4 years ago. And would that be to the UK tax office or to the ATO, or I would add both? So perhaps you, Alan.
Yeah, this is a capital gains tax question. I perceive, depending upon the visa status of the inquirer, I'll assume that she's a citizen or permanent resident. So in Australia, subject to capital gains tax on worldwide disposals. So certainly there's a need to report the disposal to the Australian Taxation Office in the tax return for the year in which the sale takes place. Being land, I think land doesn't need to be, disposal of land doesn't need to be reported to the revenue in the UK, even though it's located in the UK. If it was residential property, it would certainly need to be reported. I'd need to take on notice the question about land, but referencing in Australia the value of the property, value of the land, when the inquirer became tax resident, is our cost base for the purpose of computing the gain in Australia. Yeah.
Okay, makes sense. I left Australia in 2001 to live in the UK and now have dual nationality. I don't ever intend to return to Australia on a permanent basis. There is a deceased estate in Australia. My share would be around 100,000 Australian dollars. The property was their parents' main residence, is not yet sold. Became a deceased estate to 26th of October 2020. Is it possible that the deceased estate may have to pay capital gains tax because I live in the UK or my siblings live in Australia?
Yeah. Do you want me to answer that, Alan?
Yeah, please go ahead.
Go for it, James. Go for it.
Yeah. Okay. Yeah. With that, so we're really looking at, because it was their main residence, that there would be no CGT to pay on that. In any case, regardless of where that the beneficiaries lived, provided it's sold within 2 years of death, because it was there's a main residence exemption in Australia as there is in the UK. So that would be fine there, and normally it doesn't apply to Australian real estate because Australia seeks to tax that anyway. So you should be okay there, and the UK wouldn't tax the receipt of that distribution either. It would increase the size of your UK estate then, but I think whether that stays in UK or Australia.
You mentioned potentially capital gains tax for when you pass something to a non-Australian resident. Is the capital gains tax based on the cost of the asset to the person who bequeathed it?
Yes, it looks back at the date of death valuation versus the date that they acquired it. So as in the deceased.
Yeah.
That's effectively what the tax would be on. We don't have the same concept as the UK does, for example, where you get a CGT uplift at death. The difference is, so if you live in an asset which is subject to CGT in Australia to an Australian resident, they inherit the cost base of the asset, where particular assets called non-taxable Australian property passing to a non-resident, because it's going outside the Australian tax net. That's why the ATO seeks to try and impose, it does impose CGT in that scenario.
Okay.
I'd just also add that if the CGT asset was acquired before September 85, it would be a CGT free. Pre the introduction of capital gains tax in Australia, so that wouldn't trigger a CGT position, I think.
Okay. For those of us in Australia with parents still living in the UK, if the parents' estates are liable for UK IHT, once that's paid, are there any other tax liabilities for us here in Australia from the inheritance? James?
Yeah, there's no, Australia doesn't have, inheritance tax here. Assuming here, it's a UK asset. So there wouldn't be, other than down the track, if that properties or the assets form part of your parents' estate isn't sold, then you might have an Australian tax liability when you subsequently sell that. But if everything's cashed up and the cash comes to you, it's only then what you do with that cash, and then it's your own tax liability.
Yeah.
Do one of you want to explain the order, because often the IHT bill is due before probate's finished, and therefore sometimes you have just a cash flow issue. Would one of you like to just elaborate on that?
Yeah, well, there is, because I mean there's deadlines for paying inheritance tax, and they can be quite tight, particularly where estates can be somewhat complex, where you've got assets in both countries and there's no cash to pay that. And so the executor is legally required to pay an inheritance tax, otherwise they can be made personally liable. So it's important, if you're acting as an executor, you do comply with your obligations. It is possible to delay that, but then you do end up paying potentially interest on the inheritance tax as well. So unfortunately, it does mean, if there's not enough cash in the estate or other liquid assets, that things like properties have to be sold. But that's sometimes why people, look at what they hold investments wise, or have life insurance to pay inheritance tax.
Makes sense.
I think I'm right in saying, James, that the IHT that's attributable to real property, you can make stage payments over a number of years. Would that be right?
Yeah, that's right. That's my understanding as well.
What do you mean by real property, Alan? Just so we all understand.
So property, residential
real estate,
houses,
real estate.
Anything.
Yeah.
Okay, next question. I'm domiciled in the UK. My parents are domiciled in Australia. What are the IHT implications for real estate and shares I will inherit?
If the parents are domiciled in Australia, then assuming the estate is in Australia, then I don't think there's a UK inheritance tax position.
I'd agree as well.
Yeah.
It would only be if they had a UK estate. If they've got assets in the UK, then that will be subject to UK inheritance tax.
Yeah.
And then, of course, it will pass into the receiver's estate ultimately, won't it, in the UK? Correct. If they remain here? Yeah.
Yes, that's correct. Yeah.
So it just goes down the generations. Okay. Domiciled in the UK, what are the tax implications of drawing my superannuation in Australia? Intend to use it to pay off my Australian mortgage. So probably one for you, Alan. I guess maybe a bit of foreign service relief education.
Yes. So I think this is perhaps more. This isn't an inheritance tax question. This is more of an issue of income tax planning. So if you've got an Australian superannuation and you draw upon it and you're residing in the UK, then everything else to one side, that sum would be taxable in the UK. But there is a provision in the UK whereby, to the extent that the superannuation fund arose prior to 2017, I think it's prior to the 6th of April 2017, foreign service relief is available, I believe. If you take a lump sum from the Australian Super Fund, foreign service relief is available to mitigate the amount of that lump sum that is subject to tax in the UK. If by contrast you take an income from the Australian Super Fund, the applicable provision in the tax treaty will cause that income stream to be taxable in the UK. So a strategy with regards to Australian Super is often a matter of considering whether to take a lump sum, whether to take an income stream. Not an inheritance tax or estate planning issue, though.
It's a fair point, and I don't know the persons not identified, but if you'd like to get in touch, because this is something we do quite regularly, and help you repatriate your superannuation in the most tax efficient way. And because of the rule Alan just talked about, the percentage of tax is not that great, but because that date is set now, it's basically growing. So it's something to address if you're
wealth accruing after that date. Wealth accruing after that date is potentially taxable. So
that's right. So it's in practice growing. So yeah. Okay. If you've lived in the UK for 30 years and you inherit property and shares in WA from your parents, what is the tax liability likely to be? How can I manage this?
That sounds like the capital gains tax with a non-resident non-resident beneficiary. I think it's an Australian capital gains tax planning point, and a need to visit the parents' will with a view to it putting in place some kind of trust. Would you agree with that, James?
I would agree, but also the question, it might be, for that property, if it's their main residence, we have the same point that's, exempt there. And it's just a question of down the track, if you decide to retain that asset longer term, both the Australian and the UK tax implications, if it makes sense to retain it. And the shares, I'm assuming they're Australian shares, so that might be, again, CGT there. But a testamentary trust is a way of avoiding that. I guess your issue would be, if you're intending to stay in the UK, is there any point in having a testamentary trust running there? Because effectively, you'd have to keep it going and it might never be of use. So we might suggest at least having the option there in your parents' wills, and things might change down the track. So just having that flexibility.
That makes sense. And then, of course, because they've been in the UK 30 years, that property, once it's inherited, will be in their estate. So it's a question of what does that now move to in terms of the exposure to IHT for the person who inherited. Okay, how does dual citizenship affect domicile?
I don't think it does.
That's my understanding too.
Yeah, we often explain it in a domicile declaration. Obviously, it helps, to acquire Australian citizenship if you're trying to prove that you've got a domicile of choice. Sometimes we explain that, I've retained my UK passport and citizenship on the basis of ease of travel. We used to say, visa travel to the EU as well, but that's probably less applicable these days.
Yeah.
That's quite a common way to explain that.
Okay, this is a bit of a lengthy one, and I think it might be another sort of income tax related question, Alan. I moved to Australia from the UK. I transferred a police pension to a super fund. I later divorced and returned to the UK. The fund was split between myself and my wife. She now lives in Oz. I live in the UK. I don't have any intention of returning. My question is, how can I access the remainder of my BT fund while minimizing my exposure to tax in either country? Ignoring the rest. I think the rest is basically saying where they're a basic rate taxpayer, Alan.
Yes.
And they're going to use the money to invest.
Much turns here on whether foreign service relief can be invoked. I think I'd need to take that one on notice, Stephen.
Yeah, I think if I'd be presented with that question, we would have to understand, firstly, the transfer in will be treated, as my understanding, as like a British pension if you bring it back. So that proportion needs to be worked out. And then if they've contributed additional funds through working, there's the foreign service relief. So that's quite a thorny problem to disaggregate, sort out different tax. So again, I don't know who wrote the question, but I'd suggest you give us a call again and we can work our way through that and untangle it all. So that's a tricky one, particularly because it's divorce and it's probably a bit of a trail. Okay, if I had been in the UK for 18 years, how long do I have to be back in Australia to ensure the HMRC has no claim on Australian assets? There you go, Alan, very topical. James, you might know the answer.
Yeah, do you want me to answer this one because you answered the previous one?
Go for it, James. Yes, please.
Yeah, so it's what you'd be classed as what's called deemed domicile now. So you'd have to leave the UK effectively it's 6 UK tax years. So you need to be out for 5 UK years to lose that deemed domicile status.
So it's a bit of maths here because it's a bit, I was talking to Alan this morning about this, a bit worded oddly on the HMRC side, but it said 6 of the last 20 years. So because it's deemed domicile as 15 of the last 20 years, if I'd in the last 20 years period, I ticked over to 15 and then became deemed domicile, but I've had a couple of sprinklings of years amongst the last 20, and then I go back. Is it possible that it won't be 6 total years, but it might be, say, 3 years because I've had 3 years interspersed other periods?
It possibly would be. I think you'd be there, you just have to be very careful about, how do you work that out? I used to have to do this counting thing. I go through someone's passport and work out all the stamps and everything to work out where this comes in as an issue. But if it's possible there. I mean, unfortunately, it's a bit easier to look to once you just have to come back and be resident in Australia, and for that time period, it's easier to get out of that than it is for someone moving from the UK to here, where it's hard to lose a domicile of origin. But it's still quite a considerable period.
So I suppose it's a complication, but it just means that the mindset needs to be that you need inheritance tax planning for at least another 6 years, even if you're in Australia. So in other words, you mentioned some of the tools that are there to prevent or minimize the exposure to IHT. And that's because there is a time period, often it's cheaper as well, because it's like after that deadline, it's not needed. So that can work for you. Are there any strategies against the reduction of the UK nil rate ban for UK domiciles? Are there any sensible strategies against the reduction of the UK nil rate ban?
I'm not sure the nil rate ban is.
I'm not quite sure. I'm not sure either, I'm afraid. I'm not sure if you mean
the nil rate ban is fixed. It's £325,000, and that endures. I can only think the Inquirer might be talking about the main residence nil rate band, but even there, so long as one's
Sometimes what people do as well with their wills, they leave a gift of their nil rate band under the will, and for example, leave everything else to their children, or to a surviving spouse, that at least make sure that they qualify for that nil rate band. I'm not sure if that's what Alistair might mean.
Yes, but that used to be the strategy before there were transferable nil rate bands, James, wasn't it?
It was, but some people still like the idea of doing it, but.
I guess the only other boundary is the £2 million limit that starts to dissolve your
to taper away, but that's only pertains to the main residence nil rate band, not to the
No, it doesn't. But I guess if someone's in that stratosphere, it's there are ways of perhaps through business property relief funds and stuff pulling money out and getting under the threshold and things like that. But again, if that's anyone's concern, then contact us. Next one, for IHT purposes, what are the precise periods of time that one can spend in the UK after moving to Australia? Are there periods of time that apply to assessing whether someone is domiciled for income tax purposes? It's a really good question, because you could end up coming back end up being tax resident just for 3 months or less even in the UK while still being Australian tax resident, but does it change your domicile, or is that a more permanent concept? So it's a good question.
It pertains to the resumption of I think, of residency, and which I'm assuming here that the Inquirer has a UK domicile of origin, and the concern is about reviving that UK domicile by becoming a resident again. It's a statutory residency test question. So the question asked, what are the precise periods? It all depends. It all depends upon one's circumstances. There are, for example, significant ties tests within the statutory residency test that's depending upon your circumstances as a matrix that will ascertain if you go beyond a certain number of days, if you've got so many significant ties, then that's enough to trigger residency. So it's very specific to an individual's circumstances, if given the individual is referencing having a UK domicile of origin.
Yeah, I probably add as well, because Peter mentioned,
I think it's for
IHT purposes. It's important because effectively you're putting stronger links to the UK there. So if you have a set pattern, every year you go to the UK for 2 months, or there's been old cases in the past, because domicile is casal based, where people went to traditional sporting events or like society events, and it was seen as a tie to the UK because they did that every year, like going to Ascot, for example, and it was saying, well, you're still UK domicile because you do this every year. So if you are doing that, thinking about, well, perhaps doing it but having a bit of variation there, or you might be going for business purposes, trying to explain that.
Yeah, I think this is really, again, another one to get professional advice on, because it is very detailed and lots of triggers in there that you inadvertently can kick off if you're not aware. So especially if you're doing that regular type of stuff, or as some say, we want the permanent summer, so they're living a bit here and a bit there. Okay.
Yeah, ideal scenario, sorry, go on.
Go ahead.
No, I was just saying, often we see a situation where it might be, people who've lived there for many years and they are happily retired now, and well, perhaps when I'd like to spend a bit of the summer in the UK, I'll buy the holiday house there for that purpose. It's just, weakening your ties to Australia, particularly if, say, that property is just available for your occupation, and both, from a residency, but also a domicile perspective. So you've got to be careful with that.
Yeah.
What you notice, I've noticed, I suppose, is a lot of people come over here and then their children choose to stay, and they're conflicted about where to live, and or choose one and make it their base, but it's not, they will spend a decent proportion of time here due to their children being here. Next one, it was mentioned earlier, the 175k residence relief. What are the rules if I have lived in it for 2 of the past 20 years, but rented it for the other 18?
I think the main residence nil rate band's available so long as it was your main residence at some point of its
in the past.
In the past, yes.
It's also the case that if I sell my house and downsize, I can also preserve that value, can't I, under that rule? So I preserve the nil rate band, that 175 primary residence relief. I preserve that even if I've sold my house and downsized. I can ring fence the original property that I sold. Is
because it came from main resident sale.
Yeah. So it's also possible to do that, which is good. Rightio, next one. Is an Australian super fund subject to UK IHT, assuming I will be deemed domicile? So maybe you, James.
Yeah, so the issue there is that it can be somewhat technical, that. So ideally, we don't want your super forming part of your estate, because then an estate is subject to UK inheritance tax. If you're UK domiciled, UK deemed domiciled, even if it's in Australia. So there you might look at passing it direct to beneficiaries as opposed to through your will. It can even be an issue for people here, and in terms of how the UK treats self-managed superannuation funds, because the UK tends not to have the same concept there. So just be careful with super, I would say.
Okay, sounds like another one to get advice on. Yeah. For a UK domicile with an investment property in Australia, will an investment property in Australia attract CGT or capital gains tax upon death and bequest to children, or upon subsequent sale of the property by the children? James, perhaps?
Yeah, so therefore we're talking about an investment property in Australia, but it appears that this person is resident and domiciled in the UK. If the property is sold, there would be Australian CGT there, because it's an investment property, and the rates are different, and this is where executor residence comes into it, depending if the estate is seen as Australian tax resident or not. Generally, the lower rate of CGT for an Australian resident estate. That's subsequent sale by children, sorry. The normal position is they would inherit the cost base of that asset, and it's only when they subsequently sell it that they would pay Australian CGT, because it's an Australian asset. There might be UK and CGT to pay though as well, and then you'd be looking at whether or not there's double tax treaty relief.
How are Australian farms treated for UK domicile? Are they treated as a rural property different to other assets? Good question again.
Yeah, I mean, I'd have to, you do have to get technical advice really, whether or not they would be classed as agricultural property here, because the UK has a concept that you get inheritance tax relief for business property and also agricultural property, and it can be quite technical whether or not it's actually a agricultural property and it's not just like a hobby farm or something. That's where it does get. We're looking at the precise definitions there of the relief.
This one's probably a slight repeat, so I'll just quickly go through it. But what happens with your Australian superannuation if you die when you're living in the UK? Is it taxed when it passes to your spouse or children? So that related to your question a couple ago, wasn't it, James, the answer? In that case, the children are Australian. Doesn't really change the answer, does it?
No, I don't think so.
No. Sorry. If an Australian resident bequeaths their main home to two beneficiaries, one resident in Australia and one resident in the UK, is there an Australian charge to CGT? Is it the same answer if the property is sold on death?
It's a main residence, so I think it's a CGT exempt.
Doesn't matter.
That's right. Yeah.
It doesn't impact the status of the beneficiaries. One resident in Australia, one in the UK. I think that's I don't perceive that has an impact. It's a CGT exempt disposal.
Yeah. The only thing you'd want to think about there is Australian CGT, is whether or not it makes sense to retain that or not, because given it is exempt, as long as you sell it within 2 years of death, then you're not going to pay CGT. Where if you choose to retain it, then you would. And this is the thing we're seeing at the moment, just with the way that Australian property prices are going. We saw a recent estate, and it's gone up so much in value in that period that they really need to sell it quickly, because otherwise they're going to end up with a significant CGT bill for that period.
Right.
And the cost base for that would be the value on the date the person passed away. Is that right?
Correct. If they don't sell within 2 years of death, but
yeah,
that obviously has changed significantly just in the past 2 years. So.
Okay. I've lived in Australia since 1994. I have pension funds in the UK. I intend to leave those funds invested. I won't draw a pension from them in the UK and bequeath them to my children who live in the UK. Do these funds attract any IHT in the UK or CGT in Australia on death? Alan, perhaps? Pretty straightforward one.
I perceive that there's no tax position here. Forgive me. I'm not seeing a tax liability here.
No. I think the question would be. I'm not. No, I guess the question would be whether you can actually do that and leave them to your children there, given it's somewhat restricted with pensions, in terms of how they're set up. But if Peter has checked with the fund provider there and you can do that, then that would seem fine.
Yeah,
makes sense. Yeah, I think it's one worth checking out, just in terms of how it relates to the taxation when you pass on a pension. Dokie.
Yes.
Which can vary. So prior to age 75, it's tax-free in the UK if you were staying. How that relates to an Australian person, it's not clear to me. And then over 75, it's at the marginal rates of the person who received it. So it's one to just make sure you're clear on at the time. I moved to Australia in 2009 with, I think, children and my spouse. I think then they're saying they separated. I have a pension in the UK that I want to leave part of to my children in the UK. I'm changing my pension company to ensure I have control over who are the beneficiaries. All adults, I think. Am I better to move what I want to provide my children to the AU, Australia, or leave that value in the UK? So the children in the UK, yeah. So what, if they've got that pension, what's best for them to do?
Yeah, so I guess it depends on the pension. If it goes direct, if you can pass it direct to the children, because then it's not part of the estate. Then in which case the outcome is the same, and it wouldn't really make sense, to move that to the UK, certainly to Australia, say if the children are in the UK.
Yeah, it's a tricky one, isn't it?
Yes.
Okay.
Yes.
Probably worth getting professional advice, I think. So if you moved it to superannuation, you took it out, or it ended up coming out as a cash lump sum, it might be a bit easier than if it somehow wound up post 75 in a taxable environment or something. So it's mostly straightforward, but there's a few wrinkles. So again, probably give us a message or an email and we can help you out. Tax planning for testamentary or Australian trusts and Australian wills has not been done, is it possible to address this with a deed of variation on death? Either of you, I don't know.
It's not, unfortunately, no. So well, I mean, you refer to Australian trusts, as in that could be a lifetime trust. It's possible to vary that. it will exist, but you can't insert a testamentary trust into an Australian will if it's not there. And we don't have the same concept as the UK, with a deed of variation made within 2 years of death. And there, it's possible to do sometimes a family agreement where you vary terms in a will if everyone's adults, but it's somewhat of a difficult thing to do, and you've got to look at the tax implications as well there.
Okay, we're getting through them. If we are living in the UK now but want to move to Australia in 10 years, is it worth setting up an Australian super now, even with minimal contributions? Alan, perhaps?
We're quite a way out. Assuming that, forgive me thinking out loud, assuming you've got the ability to reside in Australia, might be Australian citizens, maybe non-concessional contributions might be worth considering, assuming you've got a tax file number. Yes, there might be merit in doing that. I think that's one to have a chat with Stephen and the team in the UK about strategy in that regard. So there might be merit.
I think you're right, Alan. I think it depends on your excess income. So we would say in the first instance, load up and make the most of your tax reliefs in the UK into your UK pensions, which eventually can be transferred to superannuation and taken tax-free. But some people max that out and then they've still got a lot of extra earnings or cash sitting around, and then non-concessional contributions is a good way to use those allowances which expire every year to load up your super. So it's a good savings vehicle if you're pretty sure you're going back. If you're not sure you're going back, it can rebound on you in that now you've put it into an environment that's potentially taxable from the HMRC's point of view. So you have to be certain you're going back, otherwise it could backfire. If you reach 60 and cash in your SMSF whilst living being domiciled in Australia for 15 of the last 20 years, including your 60th year, what happens to this money if you then return to the UK and be domiciled the following year? So that, it sounds like what they're saying is they're Australian domiciled, I would take it as, and then they're returning to the UK with their, basically a cash lump sum, isn't it?
It is. I get you'd have to look back over the previous years then, because you're kind of going back. Now, are they then down the track to meet the 15 of 20 year rule? In which case, it would. I mean, if they move that, the money is in Australia still, it should be okay. But they move back to the UK, it's an asset in the UK anyway. So it could be taxed because it's in their estate.
So I think the key would be to cash it in before you change tax residency, definitely. And there's a load of other things you just mentioned, James, but that would be the minimum thing to get right. Otherwise, you throw it back in the UK tax net. Last question, I think. I've recently moved back to Australia from the UK, moved my money from the sale of my primary residence and purchased a house in Australia. I have a smaller amount of funds in a UK bank account. I'm receiving an Australian pension. I'm eligible to take the UK pension in a few months. What are the tax implications? I lived in and out of the UK for 14 years. I'm assuming I'll have to pay UK tax to pay an Australian pension. But for the period I was resident, I only started to take the money in August 20. National insurance pension. Yeah, this is a bit of a lots of questions in one question.
Yeah, this is an income tax. Income tax question.
It's not clear whether it's a state pension or a defined contribution personal pension.
Yeah, I think it's a relevant point here is it's the tax residency at the time you receive the pension that will determine how that income is taxed. It's not where you were resident at the time that you accrued the benefits. So if the inquirer is a resident of Australia, it's a state pension. So if it's a state pension, then that state pension, UK state pension, is taxable in Australia, given that you're resident in Australia at the time, and indeed solely taxable in Australia by virtue of the applicable provision in the treaty. It would be included state pension taxable in Australia, and you can claim what's called an undeducted purchase price deduction equal to 8% of the state pension received. So technically only 92% of the state pension is taxable in Australia from the time that you become a tax resident of Australia again.
Okay.
Is it okay to keep a bank account in the UK? Yes. Doesn't impact the taxation position in respect of the pension. It's driven by your personal tax residency. If you've moved back to Australia, you're no longer living or spending significant periods in the UK, you won't be resident in the UK. It'll be the income will be solely taxable in Australia.
Okay, there's one last question sent in by email, but it was fundamentally, I'm going to inherit £600,000 out of the UK as an Australian tax resident. Is there any issues with that? But my assumption is no, really. Once the estate's all sorted out and the cash is passed across, is that correct?
Right, yeah, come to Australia, it's fine. It's just their own, annual tax liability in Australia on whatever that's invested in.
Yes, agreed.
Okay. All right, so I've got one more question from Alistair, which was a clarification, but I might do that offline because we've taken a significant amount of people's time. The questions have been great. Hopefully that's helped everyone get a finer grasp on the topic and so on. And James and Alan, that was excellent. I appreciate all your knowledge and the clarity of your answers. It was fantastic. Even I guess I've honed up my own particular knowledge on the topic, which is also great. And thank you all for your participation and your patience today. Hopefully you found it valuable. You'll receive a link to the recording if in a day or so, once we've edited out the front and the end and so on. So you can then replay that and so on. Again, if you've got inquiries, then you can see the email to send to. That might include James and Alan. We can, if you just note that you would rather speak to them, if you haven't got their details already, then we can forward on those requests to those particular gentlemen. So thank you very much, James and Alan. Appreciate all the work you've put into it and your contributions today. And thanks everybody else for participating. And we hope to see you in some of our next webinars. We run a series of webinars on various topics through the course of the year. So stay tuned if you're interested in other topics related to cross-border tax planning and financial planning. Thank you very much, folks. Bye.
Thank you very much. Bye.
Thank you. Bye-bye.